We are halfway through 2011, and the U.S. apartment market is behaving right in line with the expectations set at the beginning of the year by MPF Research. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons, and I'm joined with Greg Willett, the Vice President for Research and Analysis at MPF Research. And Greg, I assume you're here to take a victory lap for those expectations?
Well, not really, because what we're really going to do today is look at some of the markets that haven't performed exactly as we expected, even though the national numbers as a whole look on target. So in this video, we're going to look at some of the ones that were really underperforming what we anticipated. Next video, we'll look at some of the overachievers.
And specifically, we're going to look at three individual metros that we had high expectations for in terms of revenue growth for 2011, just have not measured up so far. So Greg, why don't you get us started on that list?
Well, Jay, let's start with the South Florida area and specifically Fort Lauderdale. Revenue growth on this one has been pretty slight thus far this year, just 1.5%. All of that came on the rent side, with occupancy at this point matching exactly what it was at the end of 2010. If you look at what's going on there, really occupancy has just kind of stalled out right below the level that would trigger some substantial rent growth. And no net demand this year. So what's happening seems to be that the shadow market condos and single-family homes offered for rent are doing a little bit better than was anticipated. Certainly there are some metros across the country where we built that into the forecast. For example, in the Inland Empire, Tampa, Orlando, Atlanta, we really thought that shadow market product would capture a meaningful share of total demand. We didn't think that would be the case in Fort Lauderdale, where if you look at total employment versus the total housing stock, the excess doesn't seem to be all that great. But clearly there is some shadow market there, and if those units are priced competitively, then they have the potential to steal some apartment demand and to cap the rent growth pace that is being experienced by apartments.
And let's stay on the East Coast, just moving up a little further north to Raleigh, Durham, North Carolina. And here is one that was on just about everyone's list for top performers for 2011, but just hasn't quite measured up so far. Let's look at some data. Revenue growth here has been a little better than Fort Lauderdale, but still not much to brag about. 2.1% in the first half of 2011. Raleigh's occupancy progress so far has been pretty good at 0.7 points, taking the overall rate to 94.3%, but there's still pretty limited rent growth. Same-store rents are up just 1.4% so far this year. So taking a look at the data, what do we miss in setting these expectations? And really, it wasn't much. Certainly, we've seen some employment growth, just maybe not the levels that had been expected. And obviously, the attractive demographics are still there. Lots of young adults, recent college graduates who are more likely to rent, especially in a market where single-family home prices just didn't decline very much, even during the worst parts of the downturn. So there remains a significant premium to buy versus rent. And furthermore, new apartment supply should remain fairly minimal for the time being, at least. And so, while operators didn't achieve much rent growth in the first 6 months of 2011, it seems that they were being a bit conservative. Certainly the fundamentals are in place to have more rent growth in the near future. And furthermore, we're seeing a lot of investment activity, so there's still a lot of optimism in this market, and we've seen a number of properties trade at some high prices.
So we really think it's more timing than anything on this one, that it will in fact reach the levels that we were expecting a little bit earlier.
Absolutely.
Great, so let's go to the last one on our list here, and it's probably the big surprise for a lot of folks, and that's going to be Washington, D.C. We released our top 10 picks at the end of last year for performance in this year, and actually got a lot of grief when we moved Washington, D.C. down from the #1 spot to bottom part of the top 10 performers, and it looks like at this point maybe we were even being a little bit generous at that. What we see thus far this year, revenue growth of 2.8%, tiny improvement on occupancy, 0.4 percentage points, and about 2.4% on the rent growth number. So it's really that rent growth number that is a little bit surprisingly low. And it's interesting what you see as you dig into the details in this one. 2Q rent growth was at 2% just for that 3 months. So that's a pretty good number. And the challenge is it's less than the 3% rent growth that was seen in the second quarter of last year. And also we had a period in late 2010, early 2011, where rents essentially flatlined. And it's interesting as you talk to operators in this market about what's happening with rents, they already seem pretty concerned about the ability of the existing residents to afford these higher prices. And my follow-up question for them is, what are you seeing in the turnover rate? And consistently they say that that's not going up as they're raising rents now. So to me that says we haven't actually really hit the rent ceiling on this one yet, and maybe they're just being a little bit conservative on this one at the pricing point at this point. So we'll see what happens as we go along there, but not a great number on the rent change for Washington, D.C. at this point.
Okay, so those are our big three disappointments: South Florida, Raleigh Durham, and Washington, D.C. Greg, if you had to throw a few other markets on this list of places that have been a little disappointing so far in the first half of the year, what else would you put on there?
There are other metros that are exhibiting that same pattern that you see in Washington, D.C., and that rents are going up. They're just not going up as quickly as they had been. New York is an example. Baltimore, Nashville, another one of those on that list. So again, I think it's just operators being a little bit more hesitant than they had been, even though in the underlying data there's nothing to suggest you should be doing that yet.
Thank you, Greg. And while those were the disappointments, join us next time when we talk about the positive surprises in the first half of 2011. So until then, for Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.